The more you pay, the less you return. The less you pay, the more you return. And the big key here is, guys, you don't know what's going to happen. Decrease the price of stocks or increase the GDP. And guess what's going to happen in the next 3 years? Probably both of those. The most reliable metric at any given time, according to Warren Buffett, is the stock market to GDP ratio. Now, this is having to do with valuations, and I have made my own ratio, and if you subscribe to the channel already, you hear me talk about it all the time. But one of the things I want to reiterate is how this ratio can go up and down. Obviously, based on where I feel how extreme our valuations are, that I think there's gonna be a big drop in prices. But that's not only it. A lot of people say to me, well, Paul, you think stocks? I'm like, no, there can still be growth in fundamentals even during a bad time economically, okay? So if you're new to the channel, I want you to hear this out and watch this video because it's important to understand how I look at long-term valuations. The unfortunate part is the last 4 or 5 years have been this extreme, and many measures will say this is the worst valuations we've ever seen in history, worse than 2000, worse than 2009, worse than the Great Depression. That sounds crazy, because if your reality is, well, wait, we had 14 years of a bull market, how can that be? But it be. So let me pull this up, and what I did here, and I'm gonna explain this because this is a great video. I really want people to really hone in and make sure that they're always following fundamentals. Fundamentals in the long run will drive valuations, and valuations drive stock prices, okay? So what I did here was I created my own stock market GDP ratio. That stock market GDP ratio is based on the S&P 500. Now, the S&P 500 in its current state was started in the late 50s, but there are methods to going back to 1900 or 1929, even before then, to get very similar kind of index going there. So I pulled all the data going back to 1929. And then I pulled the nominal GDP going back to 1929. So what's nominal GDP? It's the actual GDP, not accounting for inflation, not adjusting for inflation. This is, hey, in that year. So go back to 1929. Well, this last quarter, we reported $25.7 trillion in nominal GDP. If you go back to 1929, we were at 105 billion. All right. So the US economy has grown a ton in that time. What is that? 250 times? Something like that. Yeah, 250 times larger since 1929. All right. Then, since the S&P 500 is a market cap based index, I don't need to know the exact market cap. All I need to do is divide them out and figure out some ratio. So I did that. I created this S&P index, and this is as of yesterday's close. It says September 30th here because that's the last date we have GDP, and did a ratio. All right. And then I did the ratio all the way through to 1929. So 4 times a year back to 1929. So that's roughly 380, 390, whatever the number is of data points. And that's a lot of data points. I took an average, and the average ratio was 0.929. The highest ever was 2.52. And the lowest ever was 0.329. I actually believe that the 2.52 was in 1929, 1930, something early on there. This was 1982. This was the lowest point. And if you look at it, what happened from 1982 to 2000? You had a massive bull market with amazing returns. Amazing, amazing returns. Why? Because you paid very cheap price for valuation. That's what I want to show. And when you went and bought here, you did terrible. And we're going to look through that. So here's the interesting part, that correlation. So I went and took then the following 10-year returns on average, not including dividends on the S&P, because that S&P index does not include dividends. And the average return over the following 10 years, rolling 10 years, is 6.6%, not including dividends, which makes sense because historically the average dividends are about 3%. We're very low right now. And you add that in there, you're high 9% returns, which we've always said is the historical average. Now, here's the interesting part. When you're undervalued, the average return was 9.3. When you're overvalued, the average return is 2.3%. And again, that makes sense. The less you pay for something, the more your return should be. The more you pay for something, the less your return should be. If every investment is the present value of all future cash flow, there's a set cash flow that's going to happen in the future. The less you pay for that cash flow, the more your return. The more you pay for that cash flow, less your return. If that sounds confusing, let me break this down. Let's say I was going to give you a return of $1, $2, $3, and $4 in the next 4 years. If you paid, that's how much? $10 total. If you paid $5 for it today, you're going to get $10 back. You double your money, right? That's 100% return. If you pay $2 for it today, you take 2, go to 10, that's 5x your money. Pretty solid. It's 400% return. By the way, a little pet peeve of mine, it's not 500%, it's 400%. If you pay $100 for that, you pay $100 to get 10 back, you lose 90% of your money. The more you pay, the less your return. The less you pay, the more your return. That's simple, right? So if you understand that fundamental of investing, your goal is merely one thing, the emotional side of investing. How do you pull your emotion out of it so that even when times are bad and the world seems like it's falling apart, you stay with it? That's why I like ETFs so much, because the chances of the S&P 500 going to zero, what would it take for the S&P 500 to go to zero? What would be going on in this world that would happen? Think about that for a second. Would you even care what your 401k looked like? Would you care about anything in this? Would you care about your job? What would have to happen for there to be no stock market at all, or no value to any companies out there? I can't even imagine that world. And maybe that's a possibility. I don't perceive it to be a possibility. But when we're seeing our money fall 50, 60%, it feels real and it feels like a possibility. But that's why if you stay emotionally good and your mindset is proper, you can make a lot of money. So back to our ratio. When I went and ran this thing, the correlation was a negative 0.81 over almost 100-year period. That means correlations go from -1 to 1. -1 being inversely correlated. When one goes up, the other goes down. 1 being perfectly correlated. When one goes up, the other one goes up. When one goes down, the other one goes down. And 0 is no correlation. Negative 0.81 is a very strong negative correlation, which makes sense. The more you pay, the less your return. The more you pay, the less your return. The less you pay, the more your return. And that's a very strong correlation. Now, does that mean, I don't know, but it seems very logical that the less you pay for something, the more your return. It's not even logical, it's fact. It's absolute fact. The less you pay for something, the better you're going to do. That doesn't mean you can't lose all your money, but if overall, if you look at 100 investments, if you make 100 investments in your life, the less you pay for those investments, the better you'll do overall. Because some will go to 0, some will do really well, some will do okay. But the less you pay overall, the better you'll do. So going back to this ratio, where do we stand now? Well, we're at 59.7% overvalued. Here's the scary part. When I go back in history and look at any time we were over 30% overvalued or more, our return was actually negative. And that's not even, we're double that 30%. And look how bad it got last year. 107% was at the peak. Remember, this is only at the end of the quarters. So I don't know if it actually got worse in between there. But guys, let's check this out. The last time we were fairly valued was 2012. The last time we were undervalued was 2012. Let me go back here and show you when we were overvalued back in 2000. We're higher today than we ever hit in 2000. And look at the returns were over the following 10 years. Look at that. That's terrible. -1. The worst one was -4.8%, not including dividends. But dividends back then were like 1%, 2% of the high side. So it was negative returns. Okay, let's go back. Maybe that's a fluke. Let's go back to another area where everything was highlighted in red. Let's go back here to 1964. All right, only 32% overvalued. Look at these returns. Negative. Or very, very low. Okay, what about when prices were very low? Let's go when it was very, very green, when we were massively undervalued. Look at this. Look at this stretch right here. Massive undervaluation. Look at our returns. Massive undervaluation. Stocks were better priced. Returns of nothing was below 10% a year for the next 10 years. And by the way, that doesn't even include the following 10 years when things even grew even more. This is not a coincidence. You go back and you look at all these numbers, and of course, it sucks to sit there and swallow the pill of, wait, I'm going to see like no returns over the next 10 years? Yeah, in all likelihood. But that doesn't mean you can't make money. Because as long as you're investing as time goes on, and as stocks go, even if the next 10 years look like this, you still make money by investing like this. Invest all the way along the way, and this is what you're doing. Your average is going to be that, and you'll make money. And the big key here is, guys, you don't know what's going to happen. So my big key in this video is I want to show you how do you drive the value of this metric. Well, very simple. If it's stock market divided by GDP, we'll use simple math. stock market divided by GDP. How do you make this number go up? You either increase this, right? Sorry, how do you make this number go down? You either decrease the price of stocks or increase the GDP. And guess what's going to happen in the next 3 years? Probably both of those. My guess is it'll be a combination of both. The question is, which one's easier to fall fast, to either go up? Is it easier for GDP to go up fast or stocks to fall fast? Unfortunately, this is the easier one to happen, but it'll probably be a combination. And this is why inflation can help you in stocks. Because as inflation increases, let's say inflation was 100% this year, where would GDP go? Probably double. And all of a sudden we'd go from 25.6 trillion to 53.2 trillion. And suddenly the stock market GDP looks really good. Imagine, let's look at that. Let's say all of a sudden GDP went to $53.2 trillion. So we're currently overvalued at 60%. 53.2 trillion. We'd all of a sudden be undervalued 23%. And guess what would happen with our returns? They would skyrocket. Now, inflation being 100% would cause a lot of problems, et cetera. But that's what I want you to remember, that it's always going to be a temporary thing. If you believe this, if you believe that paying more for something means less return and paying less means more return, and if you believe that the stock market and GDP should work in tandem somehow, then you'll make a lot of money by being patient. But you got to strip out all the noise. You look on Market Watch, you even look on our website, everythingmoney.com, and the news is always, we just have a data feed of news. And the news always goes right to what justifies the current results. Look at Tesla. Tesla's at 148 this morning, 145 it got to, and it was at 414 just in the last year. But now what's the news? Oh, he took over Twitter. That sucks. All these things, he's selling shares. That's like, well, okay. To me, it's overvaluation. It's just you cannot justify those valuations. Now, you might sit there and say, Paul, you don't get it. I don't get it then. But I look at it saying it's always been this case. Whenever there is good news, whenever a stock is flying high, the news justifies that high flight. Whenever a stock is falling, the news justifies that falling. The question is it rational? Is it an overreaction? In most cases, it's an overreaction on both sides. Now, overall, the market tends to be efficient, but at any given time, it's never going to sell for what it's worth. The question is, if we were at overvaluation of 20%, guys, I'd be much more aggressive about buying because, we can grow into that 20% very easily. But when you're at 107%, it takes a lot of effort. It takes a lot of growth in GDP and a lot of falling in stocks to get to a point where you want to be there buying stocks. So I bring this up and I want you to hear the positive of all this, because recently a friend of mine said to me, oh, Paul, these companies all agree with you that the world's falling apart. I'm like, I don't think the world's falling apart. I'm very optimistic. I think 10 years from now on this channel, we're going to be talking about GDP at much higher numbers, maybe 40. I don't know what the GDP is going to be in 10 years, 40 trillion, 35. I have no idea. All I know is I believe in the US economy. I believe in the world economy growing, and I believe that stocks will follow along that path as long as you pay a reasonable price today for that value, you will do well. Thank you very much, and please follow the channel.